Hi class, I'm happy to be with you here today. We are doing exercise 2-9. I'm sorry this is not my normal format, but actually this is how I did it last semester and it really works pretty well. And as soon as the person comes back that can help me figure out why my other videos are corrupted and I can't get them uploaded to Blackboard, we'll be back in business. So, or to YouTube first and then to Blackboard. Okay, so we're looking at exercise 2-9. We're going to record some journal entries. Okay, so it's a brand new company, and A says that Casey Spade, owner, invested $100,750 cash in the company in exchange for common stock. So that means she wrote a check, the new owner that's starting the business wrote a check out of her personal account, and we put it into the company account, so that would be a debit to cash for $100,750, and we would have issued her common stock in exchange. So she's the owner and she owns stock in our company. Okay, B, office supplies. It says that we purchased office supplies for cash. So when we see office supplies, we assume that is the asset account. That means our office supplies inventory. Again, it said for cash, so that means we wrote a check. If it meant for you to expense it, it would tell you office supplies expense. That's how this author handles it. Okay, then the next one on C says that we purchased $10,050 of office equipment on credit. Okay, so office equipment is a long-term asset. We are going to increase it by debiting it for $10,050. And it said we purchased it on credit, which means they are going to give us an invoice and we are going to pay them later, which means we owe them, and that is a liability, and that is accounts payable. Payable being the operative word. D says that the company received $15,500 cash as fees for services provided to a customer. So we did some work for a customer and they immediately paid us. That's a really wonderful thing. So we're going to make a deposit for $15,500, increased cash, credit revenue, because it said we already did the work for them. So we have earned that revenue. Okay, E, the company paid $10,050 cash to settle the payable for the office equipment that was purchased in transaction C. Okay, so back up in C, we bought the office equipment. Do not make the mistake of recording office equipment again. We've already bought it once. This time we are reducing the accounts payable that we recorded up here. So we're going to debit accounts payable, which reduces it. And of course, to pay our bill, we're going to write a check. So we're going to credit cash. Okay, F, the company billed a customer $2,700 as fees for services provided. So we've done the work. They owe us the money. We gave them an invoice for the work that we did for them, and they owe us. So we are going to record that as accounts receivable. And of course it said we did the work, so that's revenue for $2,700. Okay, G, the company paid $1,225 cash for the monthly rent. Okay, it's just for a month, so we're going to call it rent expense. $1,225. It said we paid it cash, so $1,225 taken out of cash. H, the company collected $1,125 cash as partial payment for the account receivable created in transaction F. Okay, so up here in F, we did work for the customer for $2,700 and we billed them. Well, they don't have the whole $2,700, but they're going to pay us what they have. So we're going to increase cash for the check they gave us, $11.25, and we're going to reduce their account with us. So we're going to reduce accounts receivable for the partial payment of $11.25. And of course, when you really keep the books for somebody, you've got a separate accounts receivable account for every customer. Okay, we don't just lump them all together. We'd never know who owed us. Okay, the company paid $10,000 cash in dividends to the owner, who is the sole shareholder. Okay, if you'll remember, dividends has a debit balance. It is a contra equity account. It is against equity. We are paying our shareholders out of our checking account, but they already own the whole company. So we are just returning something to them that they already own. So dividends is not an expense. It is a contra equity account. We reduce the equity of the firm when we give part of it back to the owners. Okay, that's where I'm going to stop on this video. In the next video, we're going to post to the T accounts and make a trial balance.